The vote in the United Kingdom to exit the European Union, or Brexit, may have helped stave off a Federal Reserve interest rate hike here at home. According to the minutes of the June meeting of the Fed, it wasn't the vote itself, it was the uncertainty about the outcome that influenced policymakers to hold steady on rates for the time being. So now what happens to monetary policy and interest rates and the global markets in general? Well, here to talk about the implications is Bill Adams, international economist at PNC Bank in Pittsburgh. Welcome, good to have you back.
Thanks, Bill. Good to be here.
Yeah, so everybody, we were just in our prior segment talking about the world still scratching its collective head a little bit about the implications of Brexit. Are you still doing a little head scratching too, looking at?
I think the real surprising thing to come out of this is that prior to the vote, we were thinking about the downside risks if they were to vote to leave in that referendum. And we were worried about global financial volatility. We were worried about the pound sort of depreciating against the dollar and pulling a bunch of other currencies weaker and making the dollar stronger, and that would be a headwind for U.S. exports. And we were worried that it could turn into sort of a broader Eurozone or European Union or even global recession. And where we sit today, the referendum did favor leaving, but the stock market volatility that we saw the Friday after the decision reversed pretty quickly, and stocks have been remarkably resilient to Brexit. So we don't see that financial volatility generating the same risks to the U.S. growth, to the U.S. outlook that we were concerned about prior to the event.
That's funny. So yeah, the financial calamity that some had foreseen really hasn't materialized, at least for the globe. But interest rates are kind of fascinating to watch right now.
It's amazing. So the U.S. unemployment rate, we were at 4.7% in May. We'll see where it comes out in the June report, which comes out Friday morning. But the U.S. economy is pretty close to being back to normal after the Great Recession, and yet the government borrows for 10 years for less than 1.5% right now. It's astronomically low interest rate.
And I guess typically at this point in a recovery with this level of unemployment in the country, you would be expecting to see interest rates starting to go up, right?
And that is what we were expecting at the beginning of the year. And I think one of the reasons why we haven't seen that, well, we did see a slower start to the year in the United States, but I think maybe more importantly, especially as the international economist, I'll say that what's going on overseas is holding down interest rates here. We've got negative interest rates in the Eurozone. We've got negative interest rates in Japan. We've got very aggressive quantitative easing programs in both countries that hold down long-term interest rates there. Actually, the 10-year government bond yield in Japan and Germany is negative right now. So 1.5% relative to a negative number, I think negative 0.2 or 0.1 there, we're actually quite a bit higher.
It's a healthy return among U.S. government securities, but negative interest rates. So people are basically saying to the government, we'll pay you to hold our money, or we'll pay you to let us lend you money.
That's
right?
Well, that's right. And it's commercial banks are paying their depositors on negative interest or paying their borrowers negative interest on loans, and commercial banks have to pay the central bank interest for all the excess cash that they hold on deposit at the central bank. And we understand why this is happening. Central banks in those economies pushed interest rates all the way to zero. They tried quantitative easing and they wanted more stimulus. And so negative interest rates were the next step that they took after zero interest rates, after quantitative easing.
And Brexit is just fueling that. And, it's kind of
Brexit, I think it'll mean that those negative interest rates overseas are going to continue longer into 2017 than we were expecting before the vote. And it means that we'll probably see interest rate cuts in the UK. We'll probably see additional interest rate cuts in Japan and an extension of quantitative easing in the Eurozone. Add it all together, it means there are more reasons for U.S. interest rates also to stay lower, long-term U.S. interest rates over the next 12 months than we were expecting on June 22nd.
So do you see the Fed then standing pat for the whole year, or do you still think there's some room for the Fed to move before the end of this year?
Well, we draw a distinction between short-term rates that the Fed controls and long-term rates that the Fed influences, but there are a lot of other things entering into it. On the short term, we think the Fed, they're likely to raise rates before the end of this year, especially if oil prices continue to stabilize. That will tend to raise CPI inflation, or the outlook for CPI inflation in 2017. And the unemployment rate where it is now means that sooner or later we should see wage growth start to accelerate, and that's one of the signs the Fed is looking for, that inflation's headed back to where they want it and the economy is looking healthier. So we think we'll probably see that next rate hike. Right now it looks most likely in December. September's probably too close to the election, and then July is too soon after the Brexit referendum.
Okay, so I only got a minute or so left. I just wonder, looking at this whole political, economic situation we're in right now, what does it really mean to our region, do you think, in the near term?
I think in the near term it means it's a new source of risk and a new source of uncertainty, but the actual change to the outlook is not that large. For if you're working for an American company or a business that its operations are mostly in the U.S. or even just global but not in Europe, the effects will probably be pretty limited and actually might be offset by the increase in U.S. housing market activity that we'll probably see with interest rates so low.
Okay, so very, not a bad picture, all considering.
Could be worse.
We shall see. Well, Bill Adams from PNC, thank you so much. Really
Thanks,
appreciate
Bill.
your perspective. Sure enough. And when we return, the science of growth and how it can help promising startups to get bigger and bigger. Stay with us.